their head.
But these are foundational problems, Joe.
Right.
And without lithium, without copper, without energy, you don't have AI. You don't have the disruptive technologies that we've been talking about over the last decade.
No, it's totally true. And I do feel like, you know, there's this point that people have made that because of the nature of the economy over the last decade, there was underinvestment in the space. And I think that's true. But the other thing is, like, probably just a lack of, like, smart people going into these areas. Because if you're coming out of college or you're young or et cetera, like, did you want to go into petroleum engineering? Or probably not. And now there's probably, in addition to a capital deficit, a talent deficit, and all of that is going to have to be made up as well. So I think it's going to be a long cycle, because suddenly we're faced with these, like, pretty profound problems, as you said, that I think by and large, a lot of, like, people would, like, let their minds drift away from the realities of, like, we still need to consume stuff.
Well, and you think about, right, the global competition. I had a conversation with someone who said, you know, China gets it. They send a lot of young people here to get engineering degrees and then bring them back home. You know, like, they understand the importance of it. So you do wonder what this means kind of globally. I mean, China's kind of got their plan, and what will it mean in terms of global competition going forward?
I do wonder, like, you know, a rich society such as the United States, like, you know, we sort of, I think, assume that some of these fundamental problems of, like, food security are solved problems, right? Or electricity, which I think by and large most people take for granted, that you flip a switch and you're like, but the U.S., we've heard this year that some of the major utility things is like, look, we're sort of, like, running thin on spare capacity on the grid. So all these things that we just sort of take for granted, I think are suddenly, like, very, like, top of mind once again. It's like, no, we actually continue to need to work these problems. They're never going to be solved problems.
Look at food during the pandemic, right? Like, I mean, it was just staggering to once again see food lines.
Yeah, Californians who are listening or watching right now might recognize rolling blackouts from the summer that they have to deal with as a result of energy scarcity or the grid being overwhelmed. Joe, what are the themes that you're going to go back to New York with in terms of thinking about Odd Lots podcast? I mean, what are some new topics that you're gonna develop with regard to what you saw here? Like, what's piqued your interest?
You know, there's a few different things that are interesting. So I think, like, you know, who is, like, really sought out at these things? It's always like pension funds with, like, tons of cash, right? Because everyone would love to, like, you know,
get some of that cash,
get a meeting, get some of that pension fund cash. But the interesting thing is, and speaking of, like, stories that have reversed, how much the pension fund deficit. Now they're all flush, and so many of the big pension funds are well ahead of, with the rise in asset prices that we've seen. Suddenly, a lot of them are are well ahead of target, and a lot of these deficits are gone. And so I think that's going to be a really interesting question, like how they change their allocation. Plus, we're now in a period where portfolio assumptions that worked for 40 years, that if the stock market would go down, then at least, like, the bond component of your portfolio goes up. That hasn't worked at all in 2022. That's been a disaster. So it's like stocks and bonds. So all these, like, sort of, like, big challenge, all the people with, like, money, I think, have new problems to solve.
I'm thinking of our lineup yesterday and today, how much and this is Milken, talking so much about private capital versus the public. And I think about your conversations. I read your writings all the time, and your podcast. Like, how do you think about where we're going to be, public versus private markets, in the years to come?
I was thinking about this too this morning, because if you just talk, like, everyone here, it's like, what do you do? It's like, oh, you know, I investor, do some VC, and some alts and some PE and stuff like that. The last 10 years has just been incredible for them. Like, right, like, if you had your finger in a VC pie and a PE pie, years are probably the best 10 years you're ever going to have in your entire life.
Or even in the S&P 500.
Incredible, right? And so I now think, like, there's some, like, serious, like, questions about all these people, all these, like, allocations that worked great in a low inflation, low growth environment in which, like, leverage is really prized, where there was a big illiquidity premium if you could hold it, all these things. And I suspect a lot of investors are going to have to go back to the drawing board. Even today, with the news about Tiger Management now off 45% of their high watermark, these are serious deficits to climb out of. They had one strategy that worked astoundingly well through the 2010s, and if we continue to have this sort of, like, a different macro regime, it's not obvious, like, what the new thing is. And I think this is going to be, for all of us here, like, a big, like, question for our reporting.
It does feel that way. We got a lot of fodder to go back home.
Tons to talk about. Tons to go.
I'm so glad we were able to catch up with you.
Anytime. It's always a pleasure.
It's so wonderful. Joe Weisenthal, of course, of Bloomberg, our Bloomberg Digital News executive editor, of course, host of the Odd Lots podcast. Carol Master, Tim Stanovic, Business Week, and this is Bloomberg.
Close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left in the trading session on this Tuesday. Romaine Bostic out in Beverly Hills. Taylor Riggs and Katie Greifeld in New York. We're joined right now by our colleagues Carol Master and Tim Stanovic. We welcome our audiences across Bloomberg television, radio, and on YouTube. Another interesting day here in the market, of course, just a few hours away. I guess what? Less than 24 hours away from that big Fed decision.
Yeah, right. It's all about the Fed today, and that's what we're thinking about. I've been keeping an eye on bank stocks. The KBW Bank Index, it is up nearly 2% in today's session. A little bit off highs, but you can see Fed, the rate hike certainly impacting the financial sector here, Tim.
Yeah, and focusing on the S&P 500, investors really haven't made up their mind about whether or not they should buy or sell stocks today. We've seen the S&P 500 move between gains and losses about a dozen times so far today, Taylor.
Yeah, let's talk about that. The intraday volatility, Tim, that you correctly point out. We're taking a look at some of the major averages here, Katie, and really surprise, we're back sort of fully in the green, sort of re-embracing a little bit of a buying up the dip. I know that we're going to have a great conversation later about some of the bulls versus the bears on the street here, but at least for now, you're looking at S&P 500 up about 0.7%. Tech a little bit of the laggard on the day, but you're still up about 3 to 4% on the day. And a SOX and a Russell 2000 up about 1%.
Yeah, Taylor, if you think about that debate, definitely the bulls are winning today, especially on the sector level. If you look under the hood, you have 9 of 11 S&P 500 sectors in the green right now. Just 2 are down and not by too much. You have energy out in front, almost 3%. Even though oil prices are taking a bit of a breather today, definitely broad participation in this rally that we're seeing ahead of the Fed.
I want to talk about broad participation. One of those, a big mover here on the day, Western digital activist investor. We know Elliott Management, of course, asking the company to spin off the disk drives from the flash memory unit. Shares there for our radio audience are up 15%. I think what's interesting is now in the red, just flipping from green to red, is Avis Budget Group. Sometimes too much good news is actually bad news. Analysts wondering how you even recommend buying this stock at these valuations. So it's actually turned red here on the day. That note, of course, out from Adam Jonas over at Morgan Stanley. Clorox is also one that I'm following because Jeffrey's calling it a mixed quarter. You have the shares up about 3% or so, but really highlighting the big inflationary expectations for a reason for the cut in that full year guidance. Finally, still up about 2% is Pfizer, even though perhaps maybe some of the revenue from the COVID pills missing expectations just a little bit. Carol, as we think about some of the individual movers, but I really think, as Romaine said, we're kicking off less than about 24 hours here to go until about the Fed meeting. Take a look at this terminal chart, and I think it really wraps up, Carol, some of the good economic data that we got this morning. 2 jobs per every 1 unemployed American. That really shows you how tight this labor market really is.
To say, Taylor, I think that's been one of the big themes here at Milken. Specifically, when you talk to executive CEOs of companies, they're all thinking about attracting the talent that they really need to get the job done. Speaking of the Fed, of course, it's on all of our minds. Ken Rogoff caught up with our team at Bloomberg earlier. He's the former chief economist over at the IMF, now at Harvard. Here's what he had to say about Fed action.
I think the idea that just to 3% would be enough is really unlikely. I think they're going to have to raise interest rates to 4 or 5% to bring inflation down to 2.5 or 3%.
And of course, that's Ken Rogoff, former chief economist over at the IMF, now at Harvard. And so, you know, a more aggressive Fed, how much of that is already priced in the markets? It's interesting. I think that markets and investors are expecting the Fed to maybe go even, higher and stronger, if you will. But it's interesting to see, with that thinking, the markets in terms of yields coming back a little bit today.
Yeah, we just had a really interesting conversation with Barry Stern, like the chairman and CEO at Starwood Capital Group. He made the point that he believes that the Fed is actually behind the curve, and the Fed is late to this. And he made the really interesting point that, the Fed can raise interest rates as much as it wants, but that's not going to open up ports in China. That's not going to fix the supply problems that we see as a result of lockdown. So even if the Fed does raise rates and decrease demand for certain things, it doesn't necessarily solve supply chain issues.
Yeah, and I think one of the themes that we've talked with a lot of folks about now is the competition now. Before it was all about the search for yield. Now it's kind of a competition between yields. I guess that could be an opportunity for some folks because it gives you the opportunity to pick and choose. But depending on what you're already invested in, it could potentially be an erosion. And maybe you do pivot a little bit. I was looking at that note out by the folks over at JP Morgan a little bit earlier, Taylor, where they actually talked about credit actually maybe being a place you rotate into at the expense of equities.
Yeah, Katie, certainly when we think about relative value, credit started to creep its way up and become more attractive.
Yeah, I mean, I think as we start to watch real yields march higher, 10 basis points on that 10-year real yield, haven't seen that in a while. It'll be interesting, the conversations we're going to have about how do you, allocate money? Do you go equities? Does TINA disappear, that there is no alternative argument? Does that start to favor fixed income, especially as we start to talk about, or not start to talk, we've been talking about recession fears for weeks, for months now.
Well, and the other thing is, at this point, capital preservation. That is something that's also being talked about here at Milken. Here we are with so many questions out there. At this point, is it just pulling back and really just preserving what you have in terms of your investments at this point? Tim, you mentioned Barry Stern. One of the things that struck me in our conversation with him is how much he is watching this war in Ukraine, what comes next from Russia, and talking about how in the U.S. we're kind of far removed geographically, understandably so. But if you're over in Europe, you are really, really nervous and really unsure about where this goes from here.
Carol, that's a theme that we've heard throughout the last couple of days, that the executives we talk to, the analysts we talk to, the capital allocators who we talk to, there's much more concern about the consumer in Europe than the consumer here in the United States. But still, there is this idea of cautious optimism that perhaps, even though we are seeing a pullback in equity markets, that we're not necessarily seeing a pullback, at least here in the U.S., when it comes to the strength of the consumer.
And on the topic, though, of Europe here, too, you are still seeing some encouraging signs. A lot of folks are predicting an economic downturn over there, but we heard from Virginia Morgan over at Eurasia yesterday, and she really did talk about a lot of the kind of those second-tier companies, a lot of the companies that aren't necessarily in the public markets here that are kind of moving towards unicorn status. You're seeing that in the more developed nations of that area, like over in France, but including some of those Eastern European nations that, of course, maybe are a little bit on pause now because of the Ukrainian war, but longer term, she's still invested and she still sees more opportunity.
All right, opportunities. All right, we're going to talk more about all of this in less than an hour's time. We'll count you down to the close. Beyond the Bell, our cross-platform coverage on TV, radio, and YouTube. We'll see you again. We'll count you down to the close on this Tuesday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio. Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic. Of course, we'll catch up with our TV colleagues, count you down to the close. I do find it interesting. I mentioned bank stocks. I do find
you did?
Well, I know it was hard to hear.
Interesting. I didn't know you were talking about bank stocks.
They rallied today, but even though yields have come off, but I think it's just the expectations of higher rates, to come. Although was it Barry who talked about like concerns about, banks maybe being a little cautious about,
he did. It was Barry
offering up loans. So I don't know. I think transparency, visibility, there's a lot of stuff that we just don't know right now.
Yeah, and look, we will get a better idea of the way that the Fed is thinking about the economy, the way the Fed is thinking about...
What would be your number one question to Jay Powell?
Okay, my number one question to Jay Powell would be, oh my God, Carol, you're putting me on the spot. I have so many questions for him. Yeah. It would really be about getting inflation under control. Are you being aggressive enough getting inflation under control? Do you need to tamp down demand more?
1 minute.
Through interest rate hikes or through balance sheet?
Right.
Do you need to do that? Do you need to add liquidity to the market?
Do you need to shock the market a little bit? I'm wondering, I was thinking, why not just go for it?
Just go.
It would definitely cause a definite shift in terms of market psychology, although I think it would probably scare markets a little bit, like, what are you seeing, in terms of getting inflation under control? But I just think
what would you ask him? It's tough because there's so many questions.
Are we headed into a market cycle that there just are so many unknowns? Meaning, does inflation now just run hotter from now on? We went through such a long period after the financial crisis of a low rate environment, a low inflationary environment. Is there something different? I caught up with somebody from Intel just talking about supply chains earlier here. There's some shifts going on that are going to be with us for some time and cause pressures. All right, you're listening to Bloomberg Radio.
Well, let's get to Washington, D.C. now for a check of the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. President Biden is weighing in on the Politico report that the Supreme Court is ready to overturn the Roe v. Wade decision on abortion. He called it a radical opinion that would impact every decision in your private life. Before leaving on a trip to Alabama, he addressed the question of whether Congress needs to take action and codify the Roe v. Wade decision.
I think the codification of Roe makes a lot of sense.
Senate Majority Leader Chuck Schumer says he will hold a vote on codifying abortion rights.
This is as urgent and as real as it gets. We will vote to protect a woman's right to choose, and every American is going to see which side every senator stands on.
The House has already approved a similar bill. The court has confirmed the draft opinion is authentic, but not final. Chief Justice John Roberts says he's directed the marshal of the court to launch an investigation into the source of the leak. Senate Minority Leader Mitch McConnell says, quote, the radical left is likely behind it.
Whoever committed this lawless act knew exactly what it could bring about.
McConnell calls the leak a toxic stunt. Russian President Vladimir Putin says he is ready for talks with Ukraine. The Kremlin says in a readout of a call today with French President Emmanuel Macron that, quote, despite Kyiv's inconsistencies and its lack of readiness for serious work, the Russian side is still ready for dialogue. U.S. intelligence, though, indicates Putin is planning to annex vast new swaths of Ukrainian territory in the eastern part of the country. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
All right, Nance, thank you so much. Carol Masser along with Tim Stenovic. We are live at the Milken Institute Global Conference in Beverly Hills. in California, and we have this great story that's among the most read on the Bloomberg. We've been talking a lot about Milken, but this is certainly relevant to where we are.
Yeah, homes are fetching $1 million bids over asking in the crazed state of California, at least crazed from a real estate perspective. Here's an example. Okay, 2,500 square foot, 2-floor house listed in Berkeley last month. It was listed for $1.795 million, according to our reporter John Gittleson. The property was built in 1935. It was extensively renovated. It got 28 offers. Carol, it sold to an all-cash buyer for $4 million.
Oh,
unbelievable.
My God. I mean, we talk about frenzies, but when you start to see the numbers, Barry talked about it with rents, right? That they are, staying high and staying very strong. And so you do wonder, like, where does this all go? Markets are cyclical. So what happens? Real
repercussions. For a lot of Americans, the biggest source of value in retirement is their home. They spent 30 years paying off that mortgage.
Yep.
Their kids leave. They sell the house. They downsize. They're on a fixed income. And they can use that as a way to retire and live for the rest of their life. I have a friend who I went out to dinner with last night, Carol. I haven't seen him in years. He lives in Orange County. He and his wife have 2 kids, great jobs. They are priced out each and every weekend. They go look at homes, all cash, over asking prices, and it's been happening the last 2 years.
So what do they do?
They're renting. They're still renting. And look, they're in a great neighborhood. They like the schools in the area. They want to stay in the area. They would like to buy.
Yeah, right, because that's what we do.
So what does that mean for a generation of Americans then in terms of retirement?
We talk about generational wealth, and let's go to, racial inequalities.
Yeah.
We know that minorities, Black Americans, they've had trouble just creating that home ownership and generational wealth. So what does that mean if the market is so hot that everybody who could normally afford it is being priced out?
Do we start to see it cool down because mortgage rates are going higher? Is the Fed doing its job?
I think it will. But we will certainly see in the data points. You're listening to Bloomberg Business Week on Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Choppy session, but right now we do have stocks advancing. The Dow, the S&P, NASDAQ all higher. We have got the S&P up by about 0.7%. Lots going on. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks in the green. And like you said, in a very choppy session. Dow's currently up 152 points. S&P's gained 31. NASDAQ rises by 57. The U.S. 10-year yield at 2.96%. Gold is up 6. Oil is fading. And Bitcoin is down by 1.5%. Among the main 11 S&P sectors, only consumer staples and consumer discretionary were in the red. And leaders to the upside in the Dow, Boeing and J.P. Morgan, while Nike led to the downside. After earnings, Pfizer rose 2%. Estee Lauder fell as much as 12.7% before paring losses. And in other news, AT&T raised some mobile plan prices for the first time in 3 years. Wrapping things up, some of the names pointing after the bell tonight include Airbnb, Lyft, and Starbucks. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney, and to hear live breaking news over you, Bloomberg Time Squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. What's fun about Milken is you talk about public markets, you talk about private markets, you talk about old established companies, you talk about startups, and this is where we want to go with our next guest. Sheila Patel is with us. She's vice chairman of the global multi-stage investment firm. They invest in startups, B Capital. She's former chairman of Goldman Sachs Asset Management, here with us at Milken. How are you?
I'm great. What a conference.
What a conference. Well, when you come to an event like this, what is it that you're looking to find out?
You know, I think you get so many different viewpoints at a conference like this and so many international viewpoints. It's great to see people back from all around the world, and their perspectives are different. I think you get an insight into technologies that people care about, into areas where they plan to invest, places of innovation, but you also get an undercurrent of what people are really afraid of in the markets, what they're concerned about. The perspective on inflation.
So answer those questions. What are people afraid of?
So, you know, geopolitics, ongoing uncertainty, hard to figure out what impact that has in so many dynamics. It's of course the incredible loss of life and the tragedy that we see unfolding. It's the follow-on tragedies in terms of thinking about global food supply and the dislocation of people. And then it's, of course, the macro implications of that. At the same time, you see the Fed potentially raising rates. You see inflation and the influence that that's had on the consumer and on markets. So there's a lot of cross currents. And as usual, we're in May. So nobody's feeling too great about the markets today.
Well, I'm wondering if all of those challenges, those headwinds that you brought up, because you invest in startups, they create opportunities for companies that see the challenges of today or see the challenges that are around the corner, and they say, we've got a new way to help get us out of these.
Look, I think that's what makes it so exciting to be in this space, and one of the reasons that after having been with Goldman for so many years, I moved into venture and growth because I see so much hope for the future in technology. We focus on areas like healthcare, enterprise, climate tech is a new additional focus area for us, AI, fintech, and you see the ways in which it's helping. Right. The ways in which it can make change. Mental health has been a big area of focus for us, and the connection with mental health and digital health and access. So whether you think about a company like Silver Cloud, where we actually had a monetization events because of how successful they've been, or Uplift, a recent investment that really provides a network and an access point for psychiatrists and psychologists, and access for people in a new, unique way to those support networks. I think we see real potential there for innovation in healthcare, in digital access to medicine, in creation of new therapies and new growth in that. You think about enterprise, you don't necessarily think about helping the world, but enterprise actually helps companies become more efficient, and that's a really good thing when you're in a challenging market environment as well. And so on and on, I think you look through what's going on in technology, and what we have to try to do is dislodge this idea that tech is some monolith and it's all the same. There are so many different facets of tech and so many different ways in which it can help us in challenging times.
If you had to pick one area in terms of whether it's an ESG or green aspect, or whether it's healthcare. Like, I'm hearing a lot about healthcare again, and maybe it is because we came off the pandemic and realized, wait, there's ways we can do it, whether it was telemedicine or how we need to increase access. Is there one area in particular where you feel like you're committing a lot more investments at this point, or finding opportunities to?
Yeah, look, I think all the areas I mentioned I'm
So
pretty
kind of
passionate
equally?
about.
Yeah.
But I would say, healthcare is a great example. I'm pretty passionate about that, having been a beneficiary of creative medicine myself, and seeing the benefits it can bring. And I think the pandemic is a good indicator, an example of change in an accelerated pace. Nobody was seeing their doctor digitally, virtually 3 years ago. Now people almost crave that kind of access, including all different generations. And that generational change is huge, because getting the older generations to necessarily want to use that would have taken 10 years or never. Instead, it's now normalized. Similarly, fintech, most people think fintech finance companies not benefiting people. Actually, ease of payments, reducing friction, particularly thinking about places like India where there were 20 middlemen, and now you can reduce that to no middlemen and really get people, the money that they deserve and allow them to spend it the way they need to for their families. There's a lot of innovation out there that can do good.
Sheila, you mentioned some of the challenges that we're seeing in the macroeconomic environment. I'm wondering how these are manifesting in the individual companies that you support. In the last minute that we have, how do you take an approach at B Capital to sort of help the challenges that these companies face when it comes to talent, when it comes to technology, when it comes to other obstacles that they're facing?
Well, I think there's two parts. One is we always have a focus, even in the initial stages of investment, in evaluating unit economics, cash flows, really working with companies that get it in terms of how performance has to look in good and bad. But the second piece is we're very committed and active in our investments, and BCG is our strategic partner. So our companies are very interested in BCG's work on strategic pricing models, potential introductions to new clients, thinking about ways to grow that fit the economy that we're living in today. And that's a huge benefit we offer to our invested portfolio companies.
Just got about 15 seconds here. So when you make the investment, do you think it will be a longer runway, like bringing them to public, because there's so much private market? Just quickly.
Absolutely. I think there's plenty of ways to grow. Strategic exits and partnerships with corporates is another way that companies have potential monetization value that is not just related to the public markets.
Yeah, we're definitely seeing that as a theme. Sheila, thank you so much.
Thanks for having me.
You bet. Sheila Patel, Vice Chairman.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic live at the Milken Institute Global Conference on the West Coast. Coming up, we're going to hear about retail's new reality. We're going to hear from the CEO of Lowe's, the CEO of Kroger, and more. In the meantime, let's get an update on the markets. Let's head to Charlie Pellet. Charlie.
Well, hello there, Carol Massar. It has been a choppy day with the Dow, the S&P, NASDAQ all advancing right now. 28 minutes to go before that closing bell clangs on Wall Street. Right to the numbers. Fast-moving markets with the S&P up right now by 24 points, a gain there of 0.6%. The Dow up 90 right now, up by 0.3%. NASDAQ up 38, higher by 0.3%. 10-year up 3/32, 10-year yield 2.96%. Spot gold higher by 0.2%, 18.66 the ounce. West Texas Intermediate crude down 2.3%, 102.81 a barrel. So a volatile day. Traders are awaiting more clues on whether the Fed will be able to pull off a soft landing that brings inflation down without triggering a recession. Lots of moving parts, though, in today's trading. Sheila Patel is vice chairman at B Capital Group. Moments ago, right here on Bloomberg Business Week, she told us the war in Ukraine is just part of what's on the minds of investors.
It's the follow-on tragedies in terms of thinking about global food supply and the dislocation of people. And then it's, of course, the macro implications of that. At the same time, you see the Fed potentially raising rates. You see inflation and the influence that that's had on the consumer and on markets. So there's a lot of cross currents.
Indeed, there's also earnings. Rockwell Automation, a provider of control devices and software for industrial automation, falling the most in more than 2 years. After earnings today, Rockwell is down 14.1%. Pfizer kept its outlook for annual sales of its COVID-19 vaccine. Pfizer shares up by 2%. Avis Budget Group reported last night, ticker CAR. It's a car rental company, as you know, up by 0.8%. Expedia, after earnings, down now by 13.5%. Clorox up by 2.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, since the mid-2020, we have definitely seen the pandemic change consumer behavior, really bring on digital commerce growth globally. Well, now retailers are trying to customize the shopping experience, really manage their supply chains and inventory. And yesterday, I hosted a panel with the Lowe's CEO, Marvin Ellison, the Kroger CEO, Rodney McMullen, and Authentic Brands CEO, Jamie Salter, and Stitch Fix CEO, Elizabeth Spaulding. Talk about a CEO lineup. I began by asking the Lowe's CEO about the health of the consumer today.
There are a lot of other macro factors that we are concerned about, whether it's inflation or interest rates. When we look at the correlation between our business and key macro indicators, is age of homes, price of homes, supply and demand of homes, and the consumer confidence based on that, because that will drive their investments.
All right, so optimistic.
Optimistic. Optimistic, but cautiously optimistic,
Okay,
I guess.
I hear that a lot. How about for you, Rodney?
I would definitely agree with the same thing.
But
now,
people are shopping and they're cooking at home still. I know we are.
yeah, it's one of the things for us. People have learned how to cook at home because of COVID, and people that had no idea how to cook. And what the customer's telling us is they like it. And years ago, Columbia University put together a research paper where when families eat as a family, they stay connected as a family, the kids get in less trouble. And what we're finding is people actually enjoyed that. And one of the things that we work hard on is how do you keep inspiring people on trying to find new ideas. And we actually use our technology and some of our internal AI work in terms of suggesting things that you might like. If you like this, you'll probably like this.
And it works?
And it works. We also do it from a health standpoint. But all those things, we want, when you think food, you think Kroger. And, we think people will go to the app. Sometimes it'll be a store, sometimes it'll be pickup, sometimes it'll be delivery. And we just want to make it easy on somebody to have an incredibly great meal as a family.
Elizabeth, I want to bring you in at this juncture. Tell me about you. You also put out a fiscal quarter
for the second quarter. You raised some guidance, better than guidance. How's the environment feel?
You know, I think we've just seen a real fundamental shift in how consumers shop. And I think for Stitch Fix, you know, our mission is to change the way the world gets dressed every day to be their most confident self. And during COVID, the model of Stitch Fix became more resonant than ever. We solved these three really fundamental issues that people have around shopping, particularly for clothes: discovery, fit, and human relationships. And really the what and the how of people shopping during COVID changed, and we think really permanently. And so the what that people were shopping for during that time period absolutely changed. You know, we saw consumers asking us, you know, I'm on Zoom calls, I'm working from home, I don't have comfy clothes. And so we saw like a 10x rise in that, of course, at the beginning of COVID. Now we're seeing people like, I have no idea what to wear when I go back to the office. You know, 1 in 5 people are telling us like, I'm not really sure how to get dressed again. And 2/3 of our clients are saying, I need to like refresh my whole wardrobe. And so I think what we're hearing is just a shift to comfort, a shift to versatility, and then clients really valuing the fact that we can provide and kind of cut through the noise of online shopping and just shopping in general. Like such a big fundamental problem is, you know, finding style that resonates and actually clothes that fit me. And so really our focus has been on adapting to those what preferences, but making it easier to access the how. And really the original model of Stitch Fix, you know, it's all powered by data science and our styling community. It started off sending our clients 5 items at a time, sight unseen, them keeping what they love, sending back what they didn't. And now we've been able to really lean into fulfilling even more of their wardrobe, given more than ever trying clothes on in the comfort of your own home became more resonant than ever during these last 2 years. And we really think that behavior is here to stay.
Jamie, come on in on it. What are you seeing? How does it feel?
I would say that the consumer.
Are you cautiously optimistic too?
I think the consumer's changing a lot. Dress clothes, for sure, for men are very hot right now. Do I think it's here to stay? I don't. I do think that they will sort of come back to, you know, wearing those comfy clothes. But as we see people go back to work, they are getting out of their sweatpants. The younger generation does not want to go back to work. So that is somewhat of a problem of what's going on right now in America, is the younger generation does not want to go back to work. The older generation does want to go back to work. So we are seeing a shift of what people do wear based on really their age demographic.
And that was the last voice, the Authentic Brand CEO, Jamie Salter. That was a panel I did yesterday here at Milken about retail's new reality. The Lowe's CEO, Marvin Ellison, on it. Kroger CEO, Rodney McMullen. Stitch Fix CEO, Elizabeth Spalding. And we also have the CTO over at Wayfair. So you can really find that conversation. Go to the Milken website. You can hear it. It's in its entirety. I mean, what consumers, are you spending differently than from what you spent?
Buying less.
Yeah.
Yeah, but as I start to do more, I actually did just buy a couple pairs of jeans, like the first time I bought jeans. And, you know, I only do that every few years.
Right.
But I paid more for them than I used to.
Yeah, I do feel like everything's more expensive. All right, you're listening to Bloomberg Business Week. Carol Master, Tim Stanovic. Let's head on over to D.C. Nancy Lyons with a world and national news update. Hey, Nance.
Hey, Carol. President Biden is in Alabama this afternoon for an inspection of a factory that produces Javelin anti-tank missiles, some of the weapons the U.S. has provided to Ukraine. But before leaving Washington, he talked about another fight, the one that could result if a draft Supreme Court opinion overturning Roe v. Wade actually happens. Bloomberg's Irv Chapman has more on Biden's comments as he left Washington.
The president said the draft opinion threatens other rights the court upheld, from the sale of contraceptives to same-sex marriage.
It concerns me a great deal that we're going to, after 50 years, decide a woman does not have a right to choose. Every other decision relating to the notion of privacy is thrown into question. The decision in Roe was correct because there's a right to privacy. There's so many fundamental rights that are affected by that.
The president recalled that as a senator, he voted against court nominees who failed to acknowledge the constitutional right to privacy. In Washington, Irv Chapman, Bloomberg Radio.
The Supreme Court has confirmed that the draft opinion document was authentic. Bloomberg Supreme Court reporter Greg Storr says such a leak is highly unusual.
This was both unprecedented in modern times and something none of these justices have ever seen before. To see one of their colleagues or one of the clerks of one of their colleagues or whoever it was violate this this bond of confidentiality that they all thought they had, and it's really hard to imagine how they're going to go forward with the same level of trust they once had.
Again, Bloomberg's Greg Storr. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Masterton Stanovic, Nancy Lyons, of course, in D.C. We are at the Milken Institute Global Conference in Beverly Hills. And did you want to ask me something?
Yeah, I did. You know, the last panel, the part of the panel that we heard during the break, Carol, or before the break, they focused on trends that we're seeing and people coming back to the office, the health of the consumer, being cautiously optimistic. One area that you covered in your panel that our listeners did not get to hear just now was about how they're taking this sort of tech-enabled approach to retail. What I found that really interesting, given what Katie Koch over at Goldman Sachs Asset Management told us, the idea that, you know, technology is not really seen as, it's seen as like an essential investment right now. And
right?
when we think of what a tech company is, and look, I know that everyone wants to be considered a tech company, Carol, because tech valuations are so much better than a traditional retailer valuation.
Right.
But the truth of the matter is from the perspective of efficiency, that adopting technology throughout the process can really help with returns, delivering to consumers what they want when they see it on the website.
Don't you think about this where you shop? I do think about when I go through a customer experience where I can shop online, pick up in the store easily, or shop online, return at the store, shop at the, you know, like I am looking for really easy, I can't like overuse this omni-channel, but I do think this is how consumers want it. I'm shopping in different ways, but I want ease and convenience. And if it means online quickly, great. If it means let me do it at the store and I'll swing by and I'll pick it up curbside, and this is how they have to think about where shoppers want to be, and that includes, Jamie Salter talking about being in the metaverse. You know, they're doing stuff on Roblox.
Not sold there yet.
I don't know.
But I think it could work for trying things on. I think one area that they really need to tackle is returns, because such a high percentage of things that people order online are returned. It's so inefficient. It ends up costing companies so much money, and it's such a waste of fuel.
I don't know how they make money when they're like, we'll pay for, if you want to exchange, we'll take care of it.
Either.
That's got to impact them, and I don't know. I don't know. I agree with you. I think about Amazon too and all their shipping. How do they deal with that? All right, you're listening to Bloomberg Business Week. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Patel. 13 minutes to go ahead of the closing bell. What a choppy day this has been. Just a few minutes ago, we had the Dow, NASDAQ both lower. Right now, green on the screen. The Dow, the S&P, NASDAQ all moving higher. We have got the S&P up 15 right now, up by about 0.4%. The Dow is up 41, higher by 0.1%, while NASDAQ higher, a little changed, up 1 point right now, up by less than 0.1%. Your key takeaway, volatility ruling today's session. Traders awaiting more clues as to whether the Fed will be able to pull off a soft landing that brings inflation down without triggering a recession. Again, recapping, we've got the 10-year 2.97% right now. Spot gold up 0.2. West Texas Intermediate crude down 2.3%, 102.79 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, let's get to it. We've just got about 11 minutes left in today's trading session. And of course, we're all thinking about what the Fed will do when it makes its decision tomorrow. With us for the Drive to the Close, Anna Hahn. She's equity strategist at Wells Fargo on the phone in New York City. Anna, great to have you here with us. What are you thinking about in terms of this market environment and what the Fed may do tomorrow, or maybe most importantly, what they may say that could impact the trade right now?
Kelly, that's the number one focus of the day. It's not just about whether they can manage this soft landing or hard landing or how bumpy that's going to be. I think the focus really is, aside from the rate hike, what are we going to know about the balance sheet rolling off? Or will they actually have to actively sell any securities? That's what's on people's minds right now. And you can see the markets really reacting volatility to what's going to happen.
Okay, but we do have basically priced in at this point in the equity market and in the bond market a 50 basis point rate hike. I've asked this question many times today, Anna. I haven't really gotten an answer because I don't think anyone can see the future, but we know the market doesn't like surprises. So what surprises the market tomorrow?
You're putting me on the spot here, so I'll do my best. I think what could surprise the market, and it's pretty unlikely, I guess that's the definition of the surprise, is if the Fed decides to go much more aggressively than a 50 basis point hike and much quicker on their balance sheet roll-off. I think we're going to get clarity, and the market is going to actually hopefully see some sort of a certainty from that clarity. But were the Fed to announce something much more aggressive than expected, especially given the ongoing uncertainties with supply chain issues due to China lockdowns, and also, we have the ongoing war with Russia and Ukraine. If we get, I think, to that upside, that hawkish surprise, the market is going to see a little bit pullback, if not more.
But does it have to be a more aggressive balance sheet reduction or more aggressive rate hike, or could it be just the way that Jay Powell answers a question?
That always has an impact on investors. You'll see, what gets released at 2 o'clock versus what we get when people ask questions. The market definitely can trade, especially now we have algos that pick up on that and even transcripts. But I think rather than the day-to-day, what we need to think about for our investors and our listeners is what's going to happen over the next month, 2 months, a little further out than just the day-to-day action. And I think that is going to be much more influenced by really what is the pace of the Fed. And don't forget, they could do something quite dovish. If Chairman Powell decides to duck every question on giving clarity, some people may actually be more unsettled by that and consider that overly dovish sign not good, because that could put inflation rampant. So you also have the other side of the equation we've got to consider.
Anna, you don't think there's going to be a recession, though, correct?
Well, I'll say, Carol, in this year, we think the chances of a recession are quite low. And to be frank, it's because when we look at how equity markets have behaving and we tie that to the credit markets, we don't see what we call bad actors. We don't see really the troubled areas that we've seen in previous recessions. And to us, the equity downturn that we've seen year to date is overly negative sentiment. So we think that some of that's going to come back as the market realizes the recession is not imminent this year.
What do you make, too? And there's a fascinating column on the Bloomberg. It's an opinion piece by Connor Sen, the founder of Peachtree Creek Investments. And the headline on it is Amazon Economic Indicator says inflation is easing. And they talk about...
like that.
Yeah, exactly, right? It talks about the company's massive size and reach, made it a good bellwether. Its latest earnings suggest supply and demand are coming back into balance, right? They did this tremendous, Anna, spend in terms of beefing up their workforce, beefing up their fulfillment centers. And then all of a sudden, right, that recent quarterly earnings conference call that we got last week was like, oh my God, wait a minute. They realized they've done enough and they're starting to see kind of a new reality when it comes to the e-commerce spend. How do you look at something like an Amazon and what we got from them in their earnings release and what it tells us more broadly?
No, you bring up a great point, being such a giant in the industry that can be used as a bellwether. And I agree. When we saw that earnings report, you saw the market was quite surprised. I think there was a headline in the earnings transcript that we looked at that perhaps they were asking people to volunteer to even go home that day, employees. So when you think about what that means really for the supply-demand balance, like you brought up, I really think it's telling us that in certain parts of the market that really were what we call COVID winners. They benefited when we were in lockdown, and they really saw aggressive earnings growth during there. And they buoyed a lot of the equity market back up from lows that we saw in March 2020. You're seeing a little shift in where the consumer spend is. You've heard this phrase, instead of things, we want experiences now because we can go outside again, we can travel again. So I think Amazon is very reflective of that, where consumers are spending. But something you have to realize, too, is in earnings transcripts over and over, a big theme has been the consumer continues to spend. In the face of inflation, they have slowly dipped into those pandemic savings. They continue to spend. And that's one of their base case drivers for, again, why we don't expect a recession this year.
But that dip
can only last for so long.
Right, exactly, right? We know we've talked so much, Tim and I, here on Bloomberg, and we've done so much reporting on Bloomberg about the balance sheets of corporate America, the balance sheets of individual households. There's been a lot of research about how they are, stronger than they were pre-pandemic. But at some point, right, because they benefited from government benefits, if you will, right, and assistance, that starts to go away, no?
No, you're right. And that's the thing. When you have these training wheels, and you have this, what we said, a round of steroids on another round of steroids, you're juicing the market. And now when you take that away, you take those training wheels off, then people start to dip into their cookie jar of savings, but that doesn't last forever. And that's why to us, we don't think a recession is imminent, but we do expect a slowdown in GDP growth, and we do expect slowing earnings growth. But the timing of this for us isn't so near to right now that we think that we need to aggressively pivot our equity positioning. We still think we have a few months of that cyclicality and that last leg up in that trade, but I think as we get towards the end of this year, and particularly looking into 2023, if you're more of a longer-term investor, that's when you start looking at where are really the defensive parts of the market and where are the growth at the right price parts of the market that you want to start sniffing out.
So is it a buying opportunity right now, Anna? Because you do think that the sell-off, the downturn has been overly aggressive?
I do look at it that way, but where we see it and what range, we're still keeping a pretty tight band. So for us coming into the year, our price target year over year coming in was down on the year. But with this 12% down year to date in just, 4 months? That's the same amount that we were down in the first 8 months of 2008. So to us, it does look aggressive for what we're projecting. We do see right now as an opportune buying opportunity, but where we go right now, we would keep the risk profile of your portfolio down, but still look for that cyclical exposure without getting too far on the risk spectrum. I think, again, later in the year, we're going to start pivoting a little more towards growth and squeezing out that cyclicality. But so far, we do see buying opportunity, and our price target for the year remains $47.15 on the S&P 500.
All right. Well, certainly great to check in with you. Anna Hahn, she is equity strategist over at Wells Fargo Securities, on the phone from New York City. And we've just got a few and a half.
It's true. You're not wrong, Carol.
It's a new Bloomberg term. Check out the function, if you will, everyone. We have about 2.5 minutes left in today's trading session. And, we are going to be thinking mostly about what we get tomorrow from the Federal Reserve, but we've seen some gains in equities. All right, folks, we're going to be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We're counting you down to the close on this Tuesday.
Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic out in Beverly Hills, California. Taylor Reyes and Katie Greifeld in New York. We're counting you down to the closing bells, and here to help take us beyond the bell. It's our global simulcast with our two most beautiful partners, Tim Stenovic and Carol Massar. We welcome our audiences across Bloomberg Television, radio, and on YouTube. Carol, yes, we love you. What have you been watching?
Loving you, Romaine. Well, I'm watching this market. What a volatile trade all over the place. And maybe it's just the conflict investors are feeling ahead of that Fed decision. We know it's going to be an aggressive one, but what will be that commentary, Tim? And maybe that's why investors on edge a little bit.
Yeah, I think that the equity markets certainly priced in a 50 basis point rate hike. But the question is, what do the next policy meetings look like? And what does balance sheet reduction look like, Taylor? That's the question that they're going to be struggling with tomorrow.
Yeah, great when you think about some of the tightening of the financial conditions, sort of the impact on the market, the lift perhaps maybe that some of the equity and some of the bond markets are doing for the Federal Reserve in anticipation of a reduction here of the balance sheet. Katie, I know that you've been keeping your eye on, as well as the real yields, when we talk about those tightening of the financial conditions, and at least on the front end, a 2-year yield that is still up 3 basis points on the day.
Still up 3 basis points on the front end. You are seeing a little bit of movement in the back end, too. If we look at the 10-year yield, it's just about flat on the day. It had been down at the 2.92 level. Now it's back at 2.97%.
Yeah, and a lot of talk here about kind of what the neutral rate is, and more importantly, what the terminal rate ends up being. A lot of the panels that I've had a chance to witness here, you got people all over the map. Some people looking at 3%, and some people talking 4, 5, or 6% potentially in order for the Fed to get this under control, guys.
Let's do this here. You're going to hear the closing bells here as we await final settlement of this closing market. I think what's interesting, you get about 70% or so of the market in the green on the individual movers here within the S&P 500. But given the intraday volatility, really hard to find some of a big conviction here in the market. You're ending up here, at least on the Dow, up 0.2%, 65 points. And S&P, the marginal outperformer, you're up about 0.5% here, up about 20 points to a 41.75. And in NASDAQ technology, Carol, certainly a minor green here as well, just up about 0.2%. I think what's interesting, and you're looking at this here for our radio audience, the big outperformance has been those small cap, domestically focused inflationary, reflationary stocks.
Well, and it certainly mirrors some of the themes that we're hearing, that maybe we have a better feel of what's going on here in the U.S. domestic economy versus some of the tensions around the world. What I want to mention is one internal in the S&P 500. We get that overall number and final read on the close there, but 362 names actually higher today, 141 lower. So gives you an idea that a little bit of more of a risk on sentiment, just a hair though.
Just a hair is probably a good word for it. If you look at the S&P 500, it's only up about 0.5%. But if you look on the sector level, it's much more green than you might expect. Of course, leading the way, you have energy, you have banks, telecom. Interesting to see energy and banks leading the way really all day, even with that rally that we saw in bonds earlier today. Of course, the yield's giving back some of that right now. If you look at the bottom of the pack, there's not many of them, but you see some big losses in the consumer services. You also have consumer staples, you have communication, software, and services all down. And really, again, it's those cyclical names that are outperforming today.
And it's a big flattening of yield curve, Katie, as you mentioned. Take a look at a 2-year yield. You're up an additional 4 basis points or so on the day to a 2.77. And further, again, hovering around the 3% range, Carol, with the 2.98 on the 10-year, a 3.02 on the 30-year yield. A 2-10 spread that's a little bit flatter here. You're down to about 20 basis points or so. I know, Katie, that you're still here getting settled, but we are getting some earnings here from Airbnb.
Yeah, and we look at the first headlines out, you can see that Airbnb saw second quarter revenue at about $2 billion. That was shy of estimates. They had been anticipating $2.1 billion, and that didn't quite happen. Oh, rather, they beat actually on revenue. The estimate had been for a hair below $2 billion. They did beat on that. In terms of their first quarter revenue, the estimate was for $1.45 billion. They came in a touch above that at $1.5 billion.
Yeah, I mean, really interesting when you think about sort of the commentary that we're getting here. Better than expected in the last quarter, and looking at that better than expected big forward guidance, you guys, here on the second quarter. I think what's interesting is also a lower loss per share, Carol. So trying to improve the bottom line. You're only getting a loss per share of 3 cents. The year-over-year numbers are about $2. So perhaps maybe some of this reopening gain, of course, helping to boost both the top and the bottom line as well.
Taylor, you hit on it in terms of the second quarter outlook. I mean, here they are talking about $2.03 billion to $2.13 billion for the second quarter. That's easily beating what the street was estimating of $1.97 billion. And this plays to what we've been hearing with so many conversations here when strategists are trying to figure out where to allocate money. They're talking about consumers moving on from buying things to going into experiences, and Airbnb, Tim, plays right into that.
Yeah, also thinking about, in terms of pre-pandemic levels, just going through the press release, the financial results, the highlights from Airbnb. The company's saying that first quarter revenue of $1.5 billion grew 70% year over year, exceeded pre-pandemic first quarter 2019 revenue by a whopping 80%. The strong revenue growth, they said, was driven by the combination of growth in nights and experiences booked, continued strength in ADR, despite the ongoing pandemic, the war in Ukraine, and macroeconomic headwinds.
And of course, Airbnb shares are popping after hours, up about 5.8% at the moment. It's interesting to read through some of this commentary of Airbnb joining Expedia and Booking and saying that they really expect the summer to be really hot in terms of travel and bookings. Definitely seeing a trend there in some of these travel names.
Well, I mean, the big question, though, is this going to be persistent? Does this last here? I mean, we were talking with Barry Sternlick a little bit earlier on Bloomberg Television as well as on radio, and he talked about some of these trends. Yes, he's seeing a boom on some of his properties and the investments that he has, but he's also saying that he does expect that to taper off a little bit, that this is that pent-up demand. We all want to be out there, but the question is, what does this world, this travel world, look like, say, a year from now?
And I dare to say it, a year from now, are we talking more and more about some of that recession risk? I know here in New York, as we're focused on a lot of the big strategists, that has been, Carol, one theme that's come up, along with the theme of stagflation, along with the theme of if this is just a really good rally in the midst of a bear market, and really sort of just how you're putting all of this together.
Well, and I think what's interesting is in terms of anecdotal evidence, here we are at this massive conference. So the business spend is on at this point. I've got family who are going to graduations and they're booking Airbnb. So
Carol, if
we're
I
seeing
could
that
jump
you guys
in, we
play
are
out.
seeing Lyft numbers come out. We see the first quarter revenue coming in at just actually above estimates, $875 million. The estimate had been for about $844 million. You are seeing Lyft shares pop in the aftermath, up over 6% right now. You can see the active riders came in at 17.8 million. There was a loss per share of about 57 cents, but it looks like that is less than had been expected. There had been an expected loss of share of about $1.31. And again, Lyft shares really rising after hours, up about 6.6% at this moment.
And I want to talk to Mandeep Singh about this. I know that at least you guys for radio, our TV team is going to dive in here, because the active riders just missed just slightly, 17.8 million versus estimates of 18 million. But if you are seeing sort of that pricing power and revenue at least starting to come up, is that sort of what the market is relieved about, is sort of the ability for these companies to pass on maybe some of those fuel costs and to lower some of the incentives as well, which has been a big deal for this company?
Yeah, fuel costs. We're out here in California where it's regularly, you're ready to see a gallon of gas. Yeah, I mean, almost $7 a gallon in some places around here.
Sounds
no kidding.
about right.
So you have to ask yourself to what extent you're seeing consumers say, wait a second, this Lyft is actually too expensive, this Uber is too expensive, I'm going to take an alternate mode of transportation if they have that available to them. In New York City, we oftentimes have that available to us, and I've certainly noticed anecdotally the price is getting a lot higher in the city, and I'll take public transit instead. And I wonder what kind of data the company has that says, okay, wait a second, we're showing you a price that's too high, so you're not going to actually use the service at all.
It's a really good point. Just watching shares of Lyft, though, here in the after hours, bouncing around, still up about 2.5%. But you do wonder, and again, right, guys, the broader theme is how many of these companies, Romaine, can pass on higher costs to consumers who will eat it, or do the companies eat it and that eats into their margins?
Ida, first of all, I don't think Tim's ever been on public transit. But can we just get back to the real issue here? And that's adjusted EBITDA of $55 million. And that's with the M. So explain to me, Taylor, Miss Level 3 here, why am I supposed to be excited about $55 million in adjusted EBITDA? Are we adjusting EBITDA? I thought EBITDA was already adjusted.
Well, and apparently everyone in your world of LA and Beverly Hills and San Francisco thinks adjusted EBITDA is the actual bottom line.
Around here.
Don't even get me started on adjusted EBITDA being actual profit, because I think you do have to pay for depreciation and taxes, if I'm not wrong. But that might be, Carol,
I should have went into private equity. Why am I doing this?
For another day.
See, even from long distance, he can give you a hard time. I just want to mention Lyft bouncing around. We saw it go negative a little bit, but still up about 0.8%.
The best thing is so loud here. I can't hear a word any you're saying, but I'm sure it's intelligent.
Airbnb is up 7% in the after hours. Folks, that's a wrap for our cross-platform coverage. We call it Beyond the Bell on radio, TV, and YouTube. We will see you same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week, and I think it is interesting what we're seeing in terms of Airbnb and Lyft. We are seeing them definitely trade in the after hours. Lyft, though, bouncing around. We saw an initial rally. We're back up about 1.7%, but we did see it go a little bit lower on some of the trades. So a lot of bouncing around as we speak, and we saw Uber moving as well. But I agree with you. I've seen higher costs, certainly for Uber in New York City.
I was looking to take one from Midtown Manhattan back to Brooklyn. It was really $250. I didn't take it. I went to the subway.
Well, and then somebody's been
But that's demand destruction.
Yes.
That is demand destruction.
Right. You were like, I'm not going to do that. Yeah, exactly. But there's a lot of things going on. All right, we're going to talk with Chris Ailman in just a moment. In the meantime, back to Nancy Lyons in D.C. for a check on world and national news. Hey, Nance.
Thanks, Carol. Supreme Court Chief Justice John Roberts is confirming a draft opinion leaked to Politico is authentic but far from final. And he says he has requested an investigation into the leak. As for the content of that opinion, which reflects the majority of justices' favor overturning Roe v. Wade, President Biden says it's a radical shift that puts a whole range of rights in jeopardy if it holds.
Does this mean that in Florida they can decide they're going to pass a law saying that same-sex marriage is not permissible? It's against the law in Florida? So there's it's a fundamental shift in American jurisprudence.
Biden says he is in favor of Congress moving to codify Roe v. Wade as law. Senate Majority Leader Chuck Schumer says he'll call for a vote so that Americans know where senators stand on the issue. Well, today's primary contest in Ohio also serves as the first major test of Donald Trump's influence on Republican voters. Bloomberg's Amy Morris reports from Washington.
The former president endorsed venture capitalist J.D. Vance, but that sparked a backlash from Ohio Republican officials who warned Vance would depress Republican turnout in the general election. Vance has jumped from third to first place in the polls, but a quarter of voters are undecided. Dozens of Ohio GOP county chairmen, state committee members, and 2016 delegates for Trump urged the former president not to back Vance. Club for Growth Action backs former Ohio Treasurer Josh Mandel. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Now back to you, Tim and Carol.
All right, Nancy Lyons. Nancy Lyons there in our D.C. newsroom. Delighted to have with us. It's amazing when somebody walks by, you just grab them. We've done this before to him. Chris Ailman is with us.
Sometimes you get in trouble for doing that. Like security, it depends on who you try to grab. Security's going to come after you.
You use the word grab and it gets you in trouble. All right, he's the Chief Investment Officer of CalSTRS, the California State Teachers Retirement System, here at Milken. How are you?
I'm doing well. Good to see you again. Thank you.
Great to see you here, and great to have you here with Tim. I don't know, how would you describe where we are in terms of the market environment? There's lots of conversations going on here, and I feel like I hear a lot of cautious optimism.
Oh, and I would agree. I hear a lot of people talking about opportunities, and I'm trying to be upbeat, but I cannot be. I just said, I felt this year, 22, was going to be a choppy year to begin with in the equity market. Then with, obviously, the war breaking out and the Fed tightening and the inflation numbers, I'm very concerned. I think the Fed needs to tighten aggressively all year long.
What would you love to see the Fed do tomorrow?
Oh, 50. I don't want them to do. No, I want them to tell the market what they're going to do and then do it, so the markets are not surprised. But it will be a steady climb higher. They should not pause at 3. They should keep going. They really do need to fight inflation. I'm worried that the supply chain is completely messed up.
How high by the end of the year?
I would say we're probably going to be going through 4, and I think the curve is actually pretty flat. I think that the long end will be happy to see them fight inflation. Where the equity market is really going to depend a great deal.
Yeah, and well, I meant interest rates from the Fed. I do wonder, Chris, about supply chains, because the Fed can't fix ports in China. It can't open ports. It can't open lockdowns. So it only has so much control when it comes to pushing demand down. So what can the Fed do to ease supply chain challenges?
You're right. That's not there. They can jawbone the market, which I think they need, and he's doing. And I think he's perfecting that. I think they need to be steady in that raising of the rates. And as he said, he's all in at fighting inflation, which is the key. You still have, at some point, wage inflation. You have this 5 million people that have disappeared from the workplace. And because of that, we have these wonderful tight labor markets. But I don't see those jobs. And people tell me over half of those people are retirees. Well, that's fine. They're going to come back and work part-time. I'm wondering about all those entry-level jobs, restaurants that are only open 5 days a week, all the services that are cutting back. I don't know how they're going to get people back to work unless they do raise wages dramatically, and that's that other step in inflation after the supply chains finally correct themselves, but that's going to take a long time.
All right, so your retirees in your fund are saying, nice to hear you talk about all of this, Chris. What are you doing to make sure that I've got a good retirement?
Yeah, no, the teachers are very focused, thankfully, on the classroom, but as they retire, inflation is the biggest enemy that they face. And, right now this generation is the baby boom. They saw inflation in the 80s, so they know what it looks like. But I've got an entire generation of teachers in the classroom right now who have never seen inflation. They're not used to the prices rising. What we're doing is building inflation protection into our portfolio. We have an inflation-sensitive asset class. We have exposure to commodities. We're increasing that exposure. We're increasing...
What commodities specifically?
The whole basket.
You are?
Oh, yeah. We want to own the whole basket because it's going to be, even in some cases, stocks do well at the beginning of inflation, as we saw for a little bit in a few months this year. But we're looking, besides tangible assets, at even countries that are resource-based and therefore do better in a commodity cycle. Anything, including tips, that does well in an upcycle.
When you say countries, so are you talking about like the emerging market world in terms of their commodities?
Well, because I'm worried about currency exposure. Less about the emerging markets, but certainly Australia and Canada, even Norway. Some of these countries do better. When you break them away, they do better in inflationary cycles.
What's a realistic expectation for return this year that will not keep you up at night?
It always keeps me up at night.
That's your job, I guess. You get paid the big bucks to stay up late.
My wife will tell you, I sleep like a baby. I wake up every 3 hours and scream. But it's really one of those...
Because you've got obligations.
Oh, we got to earn 7% on average over a 30-year period. So it's a marathon. This year is going to be an uphill year where it's going to be tough to make anything close to a positive return. Our fiscal year end is June 30. We looked great at December 31. We had almost a 5% return. That's completely gone. I haven't seen where the market's choppy today. Yeah. I'm worried we're going to barely be at break even, a zero return for this fiscal year. Last year it was 21, so we have time to ride that for a while. But that pace, I think the rest of the 2020s is going to be a tough time period for us to make a steady return.
The rest of the 2020s?
I really do think it's going to...
2030?
I can't go that far out, but I think,
2029?
You got it.
Stressing me out.
Carol, nailing me.
You're welcome.
I think that we're in a difficult cycle where the midterm elections are going to roll then into the 2024 elections. This country is just so politically divided, it's almost ungovernable. And I think the stimulus, that was one heck of a party during the pandemic. I mean, I had to go to my board and say, well, it turns out pandemics are really good for stocks. We know they're not, and I think we're going to have a hangover that's going to last for a while. Not a huge recession, but choppy markets and low GDP.
Well, that's cautious optimism. Chris Elman, I'm so glad we were able to have you join us. Thank you so much.
Thank you very much.
You bet. Chris Elman, of course, the Chief Investment Officer of the California State Teachers Retirement System. CalSTRS joining us here at Milken.
Let's get a check of the trading day. Charlie Pellet has got his eye on a business news in the after hours. Hey, Charlie.
Well, hello there, Tim. Lots going on after hours, specifically earnings. Airbnb up 0.2%. Airbnb out with a forecast for revenue in the current quarter that easily surpassed Wall Street estimates as the company sees, quote, substantial demand for travel heading into the busy summer season after more than 2 years of COVID-19 restrictions. Lyft reported revenue that did beat analyst estimates. It was fueled by resilient demand for ride-hailing, even as the Omicron variant curbed travel earlier this year. But right now, after hours, Lyft shares, they are down by about 2.5%. Also reporting today, Starbucks met estimates, even as China sales dropped 23%. It does see robust demand in the U.S. After hours, little changed higher. Starbucks up by about 0.2%. We'll keep you posted on the after hours numbers also as we get more earnings. We've got the Dow, the S&P, and NASDAQ all higher today. What a session it was. You would tune in 15 minutes later, you would hear us tell you markets were up or down. That kind of swing throughout the session. Traders are awaiting more clues as to whether the Fed will be able to pull off a soft landing that brings down inflation without triggering a recession. Of course, complete Fed coverage tomorrow right here on Bloomberg Radio. S&P today up 20, a gain of 0.5%. The Dow up 67, up 0.2. NASDAQ up 27, a gain there also of 0.2%. 10-year yield 2.98% right now. Spot gold up 0.2, 18.66 the ounce. West Texas Intermediate crude down 2.5%, 102.51 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stenovic, as you know, Bloomberg Business Week. We are live at the Milken Institute Global Conference. Delighted to have with us. And what we love about Milken is it is a crossroads of financial, medical, wellness, all aspects of our life. And so with us right now is the Mayo Clinic CEO, Dr. Gianrico Farrugia. He was on a panel, actually, that talked about platforms, and we want to get into it. First of all, delighted to have you here with us. How are you?
Same here. I'm good. Thank you. Thanks for having me.
We did, so much because of the pandemic has made us rethink our world and how we do things, and platforms became a lifeline, no pun intended. So talk to us a little bit about how we need to think about where platforms take us next when it comes to healthcare.
So for Mayo Clinic, as we were looking at what do we need to do to make sure the patient always remains in the center of everything we do, we realized that if you look at healthcare in this country or even globally, when you think about all the things we need to get done, which is make sure that healthcare disparities decrease, that you can increase the quality of care and then make it more even around the country and around the world, that you need more cures, we heard about that earlier today, and that you need to make sure you take as much waste out of the system as possible. You really could not do all that in the current model, which is a platform model, which is a pipeline model, where most interactions do not leave any benefit after the interaction is over. And therefore, you need to move to a completely new paradigm for healthcare that is a global platform. And so Mayo Clinic took the step of creating the platform with a set of rules and a set of engagements that will allow anybody who wants to partake in it to get into it. And over the last 3 years, including during the pandemic, we're able to show that we could scale it and it could create benefit for patients around the world, and especially, of course, in the United States.
What does that benefit look like? This is Bloomberg. We love talking about data.
Yeah.
We need the numbers here. Help draw that line to better outcomes.
So I think it's good to make things real, right? So Mayo Clinic, we had around 7 million electrocardiograms. Electrocardiograms are a very simple test. Everybody's done one. You put leads on the chest.
Right?
EKGs, exactly.
Dr. Carroll. Wow.
And so we have these 7 million EKGs. And we said, okay, what happens if we put them in a place where it can protect the data, but at the same time make it available and run AI algorithms under it? And that what we found is that within the signal of that EKG, which normally is used to check if you have a heart attack or not, you could actually find a lot of more data in it. So we were able to show that you could diagnose 5 years ahead of another usual, much more invasive test if you were about to have heart failure or not. And you can intervene much earlier and therefore prevent heart failure. And then our gastroenterologist looked at the same data and said, well, when the liver fails, the liver puts a stress on the heart. So can you look at an electrocardiogram and also prevent liver failure? And they were able to show they did that.
Right.
And then now, a couple of days ago, we're able to show, instead of using the 12-lead electrocardiogram, you can actually use a single lead from a smartwatch and actually get to the same result, which is predictive medicine.
That's mind-blowing. So do you need an Apple? I mean, Tim and I are definitely, he's got his stuff on. And
Ring. I've got a ring on.
Do we need like an Apple Watch to ultimately take it to that next level? I mean, this is an expensive device, so maybe there's a less cheap, but is that where we're kind of going so that we can constantly be on top of this and the data can be used to really productively give us better and more equal healthcare?
Sure. Well, taking it back a step, what you need first is to create the architecture to make sure that when you give your data to somebody else, it's protected. So we found we could not use a platform model from finance, we couldn't use one from social media, so together with our partners, we had to build it. So once you build it, then you have to create a way to homogenize data. So your data will come from your Apple Watch, but it will also come from your physician. Somebody else's data may come from something completely different.
Right.
Then you can discover, so you need the AI algorithms, but to do that, you need to make sure you have trust and transparency, so you need to validate the data. And we spent a lot of time on validation before then you deliver it.
Doctor, I got to ask you something totally off script here. We've probably
have this
had...
on your side?
No. We've had about 24 guests over the last 2 days. You're the only one who walked up to us with a mask in your hand. Have you been wearing your mask around here?
Absolutely, yes.
Why is that? I mean, I have been too, and I feel like an odd duck doing it because I'm among the only people.
Did you do it at the cocktail party last night?
I was outside for the cocktail party.
All right.
Yeah.
Just check.
Talk to me why you're doing that and why you think that it seems like nobody else is.
So the data haven't changed. The data strongly suggests that masks are good to wear. Now what has changed is our fatigue. Our fatigue level is much higher, and people are making a lot of personal decisions. But fundamentally, if you want to protect yourself, vaccination and a mask are a great way to go. I'm fully vaccinated. We insist that people wear masks within Mayo Clinic. It protects our immunocompromised patients, but it also protects people like me and you when you're walking around. So the moment I leave this interview, I'll put my mask back on.
Do you anticipate, just got 30 seconds, that we will see another uptick? I mean, we already seeing them in New York City, Manhattan. Yeah. Are we going to see another uptick when it gets colder? Like, when is it?
So we need to stop thinking about upticks the way we were in the sense of numbers. We have to think about hospitalizations, severe disease, long COVID. Yes, we will see other upticks that will happen as we learn more about different variants, but we'll also get better at dealing with them. And so fundamentally, they won't be as invasive to our lives, but it would be foolish to suggest that this is over or that you no longer need to protect yourself.
We're wearing masks on our plane.
Oh, yeah.
Right?
Absolutely.
No doubt about it. What a treat. What a pleasure. Thank you so much, and I hope we can continue this conversation in the future, because I know that there's a lot more to dig into. We've been talking with the Mayo Clinic CEO. He's Dr. Gianrico Farrugia, joining us here at Milkit. You are listening to Bloomberg Business Week on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yes, indeed. You are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic here at the Milken Institute. And we've got a special guest coming up, Mark Carney, Brookfield Vice Chair, and of course the former Bank of England Governor, and also top of mind when it comes to all things the global climate. So we're going to get into that in just a moment.
First, though, let's get a check of everything happening after hours. Here's Charlie Pellet.
And we mean everything. Elon Musk plans to take Twitter public again later. This, according to Dow Jones. That news breaking now. Headline on the Bloomberg Professional Service. Musk, as you well know, has offered $44 billion to acquire Twitter. Shares up by 0.8% after hours. More proof travel is recovering from the pandemic. Airbnb sees demand for travel this summer as strong. The company says domestic demand for travel so far this year has beaten its own expectations. Airbnb moving up in the world of online travel agencies. Mandeep Singh is a senior tech analyst with Bloomberg Intelligence.
During the pandemic, Airbnb has surpassed Expedia as the number 2 OTA. Booking is still the largest OTA, but given all the, the fluctuations we have seen with the Russia-Ukraine situation, and Booking has a much higher exposure to Europe. So my sense is Airbnb will continue to do well, and plus they're diversified.
And today we saw Expedia shares plunge 14%. Wall Street, meanwhile, is awaiting tomorrow's Fed decision. Anna Hahn is equity strategist at Wells Fargo. She was our guest right here on Bloomberg Business Week.
I think we're going to get clarity, and the market is going to actually hopefully see some sort of a certainty from that clarity. But were the Fed to announce something much more aggressive than expected, especially given the ongoing uncertainties with supply chain issues due to China lockdowns, and also, we have the ongoing war with Russia and Ukraine. If we get, I think, to that upside, that hawkish surprise, the market is going to see a little bit of pullback, if not more.
And, of course, we get the Fed decision tomorrow, 2 o'clock Wall Street time. Yes, we've got the news conference live, 2:30 Wall Street time. Our coverage kicks off 1 p.m. Wall Street time right here on Bloomberg. What a day on Wall Street. Plenty of volatility after several twists and turns. Did turn out to be an up day. S&P up 20, a gain of 0.5%. The Dow up 67, a gain of 0.2. NASDAQ up 27, a gain there of 0.2%. The 10-year yield 2.97%. Spot gold up 0.2%. 18.67 the ounce. West Texas Intermediate crude down 2.1%. 102.92 a barrel. Brent, the global benchmark, down 2%. 105.42. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stenovic live at the Milken Institute Global Conference. A special guest here, and we have Mark Carney with us, of course, Brookfield Vice Chair, former Bank of England Governor, currently the UN Special Envoy for Climate Action and Finance, Chair of GFANZ, the Glasgow Financial Alliance for Net Zero, and he's also a member of the Bloomberg Philanthropies Board. So nice to have you here.
It's a pleasure to be with you, Carol and Tim.
It's your first time you said at Milken.
Yes, it is.
It is such a cross-section of obviously people, financial types, political types, all different sectors. What do you feel the consensus is, or is there consensus about the outlook? And does it gel with what you're thinking?
Well, it's interesting. I mean, I would say that, at least my impression, it's a little heavier on financial than some other conferences. So you're getting a financial perspective, although with all these incredibly important cross-cutting issues that affect all of us in society. That's first thing. So it's great in bringing that together. Second, there's a lot of focus on the short term, which is around what's the Fed going to do, what central bank policy is going to be. But really what you want to do, and the better conversations are lifting that out to the medium term. Are we going to get inflation under control? And what's the structural things that are affecting not just inflation, but more importantly, how people feel, people's livelihoods, whether it's on the health side, climate transition side, the changing nature of the global economy, and all of those come together. So it's a pretty fascinating set of discussions.
Is inflation a short-term concern of yours, or is it a long-term concern? Inflation, is it short-term or long-term?
Well, look, it depends on how central banks react, Tim, because that's the thing that impacts it. Central banks ultimately can get on top of inflation if they want to. Now, they're behind the curve. I think we all recognize it. All the central banks, in different ways of saying it, are admitting that. They would prefer to have been in that position than end up in a deflationary spiral because of COVID. So we are where we are. The water's under the bridge. They've got to catch up. Now, they have to have the determination to get inflation back to those targets, somewhere around 2%, over the course of the next couple of years. The other half of your question, but the importance of your question, Tim, is there are some longer-term forces that are inflationary. So this element of whether you call it deglobalization, slowbalization, fragmentation of the global economy, that's going to add costs. Whether you look at elements of the energy transition, not just the short-term energy crisis, but the restructuring of a lot of industries because of that, that's going to add costs. Whether you look at government spending because of additional spending on defense or healthcare, that adds costs. So all of those things add costs. You need to react to those. And by the way, you need better policy on the fiscal side, on the climate policy side, to help smooth that out. So, look, we can get ultimately inflation's a choice. We can get the level of inflation that we deserve when central banks do their job, but they are leaning against some pretty big forces that have really built up in the last couple of years.
Mark, are you concerned about, especially when it comes to climate initiatives and, promises and goals that have been laid out, that if the economy seems to get into a trickier state and a tougher situation, that those positions and those policies are pushed aside again?
Well, Carol, I think we got, again, distinguish between the short and the medium term. Now, on the short-term side, there's a scramble for energy, particularly in Europe.
Right.
Many of the sources, and in the emerging world as well, and many of the sources are higher emitting sources, in some cases coal, and that's going to use up more of our carbon budget in the short term. So that's, unequivocally bad news for the climate transition. However, what this crisis is doing is concentrating the minds of companies, of countries, to say, well, maybe the system we have right now isn't that great. It's highly volatile, it's expensive, it has issues in terms of reliability, and it's destroying the climate at the same time.
Right.
And any major decision on climate takes about 5 years to have an impact. So whether you're putting in a new LNG train, whether you're constructing large-scale offshore wind, whether you're doing something on the nuclear side or hydrogen, it takes that amount of time. So governments, and we're seeing this, if I may, just in Europe, we're seeing them take a step back and say, okay, where do we want to be 2025, 2030? And their answer thus far has been, we're going to triple hydrogen. We're going to aggressively ramp up offshore wind. We're going to ramp up solar. We're going to move on storage. So the answers are all falling on the clean energy side.
Right.
That's good news that helps balance the bad news in the short term.
Well, and I do think about, like, in the pandemic, right, that we see, the increase in digitization, whether it was the embracing of e-commerce or telemedicine, like so many things happen in a much shorter time frame. Will we see that? It sounds like in terms of energy and the transition because of what's happening in Ukraine.
Yeah, Carol, it's a hugely important point. I agree absolutely with everything you said, because we did see that acceleration. It was forced, necessity. It's out of necessity. Companies had to keep going. We saw the acceleration. And there's no turning back from that. And actually, it's net good for our economy and for people's livelihoods, right? Where they get better service and more flexibility in work. I see you can't work from home, but others can.
I did do a broadcast for 7 months from home.
Oh, fantastic. With your own Bloomberg logo in the back. It's perfect. But on the energy transition, we are seeing this acceleration. I gave you the numbers for Europe. We've seen a similar thing in the UK. The question, though, is, and this is where the jury's still out, there is a need because of Russia. They don't deserve it. I mean, that's an understatement. But we cannot rely on Russian hydrocarbons. We need to bring other hydrocarbons on stream. And the challenge is going to be to do that in a way that that those are going to transition off in time, not to lock in a bunch of committed carbon.
Well, look, we know the transition is going to be bumpy. It's going to be a challenge, and it's going to take years. When is it no longer a transition? When have we transitioned?
Well, that's a great question. I mean, it's to land it, it's 2050. I think the key thing, though, Tim, is it's a long way off in many respects, although we have to start now. 2050 is in many respects today. The decisions we take, which is why you're asking me the questions rightly, is the decision we take over the next few years are really going to determine whether we can make that transition for 2050. Now, what we're doing in the financial sector, and one of those acronyms you read out kindly at the start, GFANS, with 140 trillion of global financial assets, is to assign those assets to the transition, to manage those balance sheets to the transition, and to report to people what proportion of the balance sheets are supporting the transition today, what do they expect to tomorrow, and where do they get to? So,
Mark, one last question. Are the assets going in the right direction? And there's been such a big debate here at Milken about ESG and whether it's really being committed in the right places.
Well, I think the good news on the net zero transition, I'm going to be very precise, a subset of ESG, is a hard number. Those are emissions. They're either going up or down. If they're going down, are they going down fast enough? The one thing the financial industry can do is count. And this is the bit of ESG that we can count and we can track and see. And what you're going to see over the course of the next 6-12 months is those numbers start to come out in an organized fashion. And I'm sure Bloomberg will be reporting on it. And we'll see who's on track and who's falling behind.
We have to run. We know you have to run. We really appreciate your time.
My pleasure. Mark
Carney, of course, Brookfield Vice Chair. Thank you so much. Really appreciate it. You're listening to Bloomberg Business Week. Carol Masser along with Tim Stanovic. Just doing an update on the markets, if you could.
Yeah, I'm also keeping an eye on some news that we got that from Dow Jones that Elon Musk is planning to take Twitter public again later. This coming from the Wall Street Journal. The company, or I should say the organization, saying that that Musk is planning to take Twitter public again later after he takes it private. Carol, I saw the headline and I thought to myself, that's kind of like putting the cart before the horse, because he hasn't yet taken this company private at this point.
And there are many who would argue that the deal is not done yet, and it may be laid out.
I think everybody would argue the deal is not done yet. Have the papers been signed? I don't know.
I don't know what this means.
Yeah, I don't know if the papers been signed.
But maybe this is also, there has been concerns about some of the headlines when it comes to what his plans are for this company. And so let's
see.
find out. Yeah.
Let's bring in Mandeep Singh, Senior Technology Industry Analyst for Bloomberg Intelligence. Mandeep, good to have you with us. When you see a headline like this, what do you think?
I mean, there is not a lot you can make out about Twitter's future other than the fact that Musk is keen to finalize the financing on that $12.5 billion remaining, after his stock sale. And look, as a private equity player, you're going to be interested in this deal only if you know there is an exit strategy. So that's what he's laying out, is he intends to hold the company private for 3 years, cut costs, accelerate revenue, and I think that's music to somebody in the private equity space.
Is this just wacky, Elon Musk? Mandeep, forgive me. I know that's not related.
Is that a technical term, Carol?
I mean, how do you, as someone who's so smart about, researching companies, looking at the fundamentals, looking at the trends, but how do you then throw into the mix someone like Elon Musk?
Well, he did the same when he announced the deal, right? So he announced the deal, and then he 1 week later, he figured out the financing. He got these loans from Morgan Stanley, and how he's going to finance the deal. So I think so far he has been pretty expressive in how he's thinking about the deal and what he wants to do. But at the same time, it doesn't give me a lot of conviction that he's going to follow through on whatever he's laying out in his tweets.
Mandeep, for years, Twitter has, I don't want to say struggled, but look, the returns haven't been great. The company has been left behind by competitors. They haven't innovated the product the way that other companies have. I think that's a fair analysis. Why does Elon Musk want to take on something like this? Like, does he think that he can actually make this company a profitable company for a long period of time, make changes internally that would do that?
Well, one thing is for sure that he's addicted to the platform, and he feels very strongly about the utility of the platform, and then you layer on free speech and other things that he has talked about. But clearly, I think what he keeps getting back to is, look, this is a platform that has got a daily active user base, of 200 million plus, used by pretty much anyone in the political arena, as well as, a lot of media and professional folks. And he thinks it can be better monetized. The problem is he hasn't run an advertising business before, or neither a subscription business. Yes, he has been obviously very successful with running Tesla and SpaceX, but these are different businesses than monetizing an internet business. So that's where I think there is a gap between what he has accomplished. And look, you can never doubt Elon's ability to pull it off. And I think that's why no one will bet against him. But at the same time, I think there are a lot of unknowns with Twitter specifically, given Twitter has underperformed its digital peers for the last 10 years when, you had Meta, which is over $120 billion revenue run rate. So a lot of success in digital media that obviously Twitter didn't achieve.
Mandeep Singh, Senior Tech Industry Analyst for Bloomberg Intelligence. Mandeep, appreciate you jumping in on this breaking news.
All right, and shares of Twitter just up about 0.3%.
It's got to go private before it goes public again, Carol.
It's also like, I don't know how to take this. All right, let's just get an update on how the market's closed on this Tuesday. Let's head over to Charlie Pellet in our New York headquarters. Hey, Charlie.
Thank you very much. Well, hello there, Carol Master. The Dow, the S&P, NASDAQ, all advanced today with the S&P up 20, a gain there of about 0.5%. The Dow, very choppy session for markets, by the way, today. The Dow up 67, a gain there of 0.2%. NASDAQ up 27, also a gain of just about 0.2%. 10-year yield 2.97%. Spot gold up 0.3%. 18.67 the ounce. West Texas Intermediate crude down 1.7%. 103.37 a barrel. Well, a developing story. Just talking about it. Elon Musk has told potential investors he could return Twitter to public ownership at a later date. This, according to Dow Jones. The deal to take Twitter private, though, has not yet been finalized. Lots of earnings. Briefly, Starbucks profit and comparable sales missed estimates. Lyft reported revenue that did beat analyst estimates. Recapping, 10-year yield 2.97%. Gold up 0.3%. 18.67 the ounce. S&P up today. Choppy session up 20 points. A gain of 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, baby boomers, those who were born between 1946 and 1954, Carol, they saw the biggest overall gain in wealth during the pandemic. Their combined wealth growing by $12.8 trillion, or about 23%. That's according to Fed data from last fall. Now, all this wealth, it's got to go somewhere. And the handover of assets from U.S. boomers to their children is expected to rank among the biggest wealth transfers ever in history. We've got a great guest here to talk all things generational wealth, private investments, and more. Ida Liu is CEO at Citigroup Global Wealth Management. She joins us here live from Beverly Hills. Ida, how are you?
I'm wonderful. Thank you for having me. It's great to be here.
Well, let's start right there in terms of planning. What are you seeing in terms of generational wealth transfer at this point?
Well, it's probably the most critical thing that families think about is what do I do with my assets? How do I pass that to my kids or grandkids? And so we have a full family approach in the private bank, which is really making sure that the next generation of wealth are good stewards of that wealth, and also the millennial clients as well. So we're doing all sorts of different types of connectivity to help educate, train, engage the next generation of wealth.
How does the next generation want to engage? Because we know a younger generation wants to do it differently.
In the metaverse, Carol.
No joke, right? No, but
exactly.
how do they do it?
No, it's very interesting that you asked that. We formed Next Gen advisory boards around the world to hear directly from the Next Gens what they want.
Right.
And the number one thing they want is ease. So we've got to make it easy for them in the digital interface for them to want to do business with you, right? I mean, you can't you can't have them walk into branches anymore. They want to do everything mobily through their tablets, on their phones, on demand.
How are you thinking about that from a tech-first approach? I mean, we don't necessarily think about, well, we do because we work at Bloomberg, but we think about banks as tech companies. But I think a lot of people don't think about financial services as tech companies. And that's one of the reasons why there are so many fintech upstarts right now that are going after a large community of people.
And rightfully so, because that is the future. So we all have to evolve. One of the biggest priorities for us in the private bank and thinking about growth in the business is making sure that we get that tech digital experience right. And we want to be able to enable that ease of use, that fluidity that I was just talking to you about. Yeah. And we know that that's going to be our competitive advantage. So we're on our path to making sure that we digitize, that we make things super easy. Just to give you an example, we just launched digital data onboarding, which means that we can now open accounts completely paperless, seamlessly in 3 minutes, right? And we used to take 2 weeks with sign here tabs and a stack of papers. So again, just challenging everything and the way that we do business digitally, making it as easy as possible.
How does the younger generation want to invest? We've spent so much time here at Milken talking about the private markets and the opportunity for that. So how are they looking to invest, and how is that different maybe from their parents or grandparents?
Well, the first thing that comes to mind is that the next generation is very conscious about ESG. So they care deeply about doing good while investing. So you see a lot of focus there. Also, I mean, it's not surprising that they're focused on alternative investments, looking at private equity, hedge fund opportunities, particularly in a market like this where you're seeing a lot more volatility. That illiquidity premium becomes more attractive. Right, so when you can get net IRRs of 15 to 20% in private equity hedge fund managers in a long period of time, they're very attracted to those types of investments.
How are you building private allocations into portfolios right now? If you're thinking about, a portfolio over the next 30 years, something that is going to be passed down to another generation, what percentage of private equity is that going to be?
It depends on the specific family and their risk tolerance and their longer-term objectives, but we think an allocation to private equity and alternatives of 15% to 30% of clients' portfolios is perfectly
30%, that's
reasonable.
a lot.
Wait, say it again?
15% on average, but we've seen many situations where it's much higher than that, up to 30%. And as I was saying, because of today's market environment where you're looking for opportunities, this is where hedge funds and private equities thrive, right? In the volatility, longer-term investments. So we tend to over-allocate a bit to alternatives in this kind of environment. Also rotating out of the traditional stocks and looking at more value-oriented, dividend-paying stocks, specifically in the technology and healthcare space.
What about the crypto space?
Well, the crypto space is interesting, right? Because there's still a lot of risk. It's unregulated.
I know.
I mean, I wish we knew how to measure it, right? Because there's no way to index the crypto risk. So today we are looking at it. We're exploring ways to do that with our clients, and we're thinking about thoughtful ways of getting exposure to crypto.
Do you get a lot of questions from the younger generation about saying, or the next generation? Yeah.
Of course we do. I mean, that's something that is commonly talked about, that we think that there is a portion of crypto assets that should be in clients' portfolios, but a very speculative portion, right? A portion that's small enough to be comfortable that we're not gambling and just, making some big crazy bets on that.
When you say exposure, what does that look like? Does it look like the, companies that provide exchange services for cryptocurrencies, or does it look like actually putting crypto in a portfolio the same way that some people would put gold in a portfolio?
Sure, there's many different ways to play the crypto arena, right? We could do crypto ETFs, crypto mutual funds. You could buy the asset classes, crypto assets themselves, the Bitcoins, the Ethereums of the world. So there's many different ways to access it. The ways that we're looking at doing it for clients is getting crypto-like exposure through structured products rather than owning the underlying asset. Gives you a little bit more comfort there on exposure basis. But there's many different channels, as I say, to play the crypto space.
So when it comes to having individuals who work with the younger generation, do you need to skew younger in terms of, relating when you're talking about their portfolios or the transfer of wealth? Do they want to be working with a younger advisor?
That is a fantastic question, and that's exactly why we at the private bank have an apprenticeship model. That's pairing a senior banker with a junior banker and associate banker to cover the three generations that we just talked about. So the senior bankers cover the matriarch, the junior bankers cover the next gen, and the associate bankers cover the millennial clients. They love the fact that they can speak to their peers, that they can speak to people in their generation that understand the habits, the behaviors, and really can relate very well at an early age with our clients.
Do you find? Go ahead.
Well, how easy is it to get that talent right now when there's such a talent war?
It is a war for talent, but I'm super proud of the talent that we have. We have a wonderful culture. I think we're the best private bank on the street, and we continue to grow and build. And you probably know this, but we're doubling our private bank over the next 3 to 5 years, and we've been able to attract a lot of talent. And we also home grow our talent, right? We're really proud to be a place where people can build their careers. Many of the people on my team have been there for 2 decades, 3 decades, of their careers. And so it's a nice training ground for folks to join and spend their careers here with us.
Ida, I'm wondering if you're finding resistance among the younger generation to actually even having an advisor, having a person to talk to. We've seen the rise of Betterment, Wealthfront, robo-advisors. Charles Schwab has, its intelligent portfolio right now. UBS buying Wealthfront, for example. How is that playing into that younger generation who doesn't necessarily see that you need to talk to somebody in order to invest?
Oh, no, they definitely see the value of the advisory on the private banking side. They see the value of the service and the strategic opportunities that we do with their family members. Because keep in mind, we're not just doing private banking and wealth management. We're also accessing the power of the full institutional products and services that Citi has to offer to our families. So we do business advisory, we do investment banking services, we do commercial banking, we do markets trading for their families and their companies. So they see at a very young age the value that we add, right, as a full service, comprehensive global institutional advisor. And you can't get that from a robo. It just doesn't happen. Right? I mean, you can't get all of these different strategies and understand the businesses and how they operate in multiple geographic locations around the world. I mean, you got to have that human touch.
It's so funny because we've got to wrap up, but it's been such a theme about technology once again here at Milken. But I'm increasingly hearing people like, nope, you've got to also have humans out there that people can talk to, reach to, whatever industry it is. Thank you so much. Great way for us to wrap up.
Such a pleasure. Such a pleasure. Thank you both.
Thank you.
Ida Liu, she's CEO over at Citigroup, of course, global head of Citi Private Bank. All right, that's going to do it for our Milken Institute Global Conference coverage. So much to talk about in terms of technology, concerns about the outlook, cautious optimism, but that's going to do it. For Tim Stanovic and the Business Week team, I'm Carol Masser. This is Blue.